Retirement Lifestyle Show is back with the first episode of 2026. And what better way to kick off the year than with the 2026 Market Outlook episode today? We're going to tell you what you need to know this year to give your investments the edge they need this year for success. The past couple of years, we have seen market swings, inflation shocks, exploding onto the scene where many investors are wondering whether the next year brings opportunity, risk, or both. We're at a moment where stocks have elevated valuations. Interest rates are starting to fall, global markets are changing, and artificial intelligence is starting to shape the economy right now. These forces will play a big role in how your portfolio performs in 2026. So, in this episode, I'm going to break down what really is driving the markets and what investors should be aware of as far as the risks that are out there and how to think about building a balanced portfolio for the year ahead without getting caught up in headlines or fear. So before we start this episode, again, this is not financial advice. Ask a question to a consultant, get advice from a professional before making any financial decisions. The first section, which is just kind of looking at the big picture for 2026. One of the biggest shifts that we've seen happening right now is that we're moving away from a market that was driven almost entirely by a handful of US technology stocks. For several years, if you owned the Magnificent Seven, you did great. And if you didn't, you felt left behind. That environment is starting to change. We're now seeing leadership broadening. International markets like Europe, Japan, and emerging markets are showing real strength today. That's important because investors now need to know what regions to look into if markets start to rotate. This also adds another layer of diversification. Not only are you heavily concentrated with your investments in US stocks, but if you start looking internationally, this can start diversifying the equity and stock part of your portfolio, which could help if a certain region or area has underperformance for this year in 2026. So again, international stocks add another layer of diversification, especially when you look at Europe, Asia, starting to have some renewed strength within their markets. Another layer that works in here is trade policy. That was huge last year, especially when it came to tariffs. Now things are looking a little bit more predictable compared to 2025, which has allowed businesses to start investing again on a global scale. This adds global stimulus, especially in manufacturing sectors, infrastructure, and defense. And you can start to see why the economic outlook for 2026 looks more stable than many expected this year. Now let's change gears and talk about bonds. For the first time in years, investors can earn meaningful income without taking stock market risk. Bonds don't just generate income, they provide a more stable foundation that can help protect your portfolio when markets become more volatile. Something that bond investors look at are the interest rates. Interest rates are likely to move lower as the central bank focuses on a weaker job growth. The Federal Reserve looks at two things which help them determine what they're going to do with interest rates. That is price and the job market, the labor market. Now, 2026, instead of focusing a lot on price and inflation, the Fed is starting to look at the labor market, looking at unemployment, looking at job growth, looking at a number of things in the labor market because that right now is not looking as strong as it was back in 2021 and 2022. So historically, that's been supportive for stocks when interest rates are going down. This creates a constructive backdrop, even if we still see bumps along the way. Section 2 of the podcast is going to be called Earnings Matter More Than Headlines. A good sign for 2026 is that corporate earnings are improving across many sectors, not just in tech. Industrials, financials, the healthcare sector, and consumer companies are starting to contribute to the gains in the market with stronger earnings during their calls. That's a big deal because the Dow Jones Industrial Average, the S&P 500, and the NASDAQ are at their best and most profitable for investors when companies are growing broadly across the board. A rally driven by just a few stocks makes these indexes fragile, and a rally driven by earnings across many industries and many sectors is much more durable for these indexes. Will the broadening trend continue, though? That's what investors really want to see happening. Are we going to have this sector by sector melt up in the market where tech, energy, industrial, healthcare, utility, real estate are all doing well? Or does that trend kind of fizzle out this year, and then next thing we know, it's just tech again is where all the earnings and all the growth is starting to experience in the market again? We don't know, but that's something that you really need to focus on, especially if your portfolio is heavily concentrated in a specific sector. So this would be a good kind of gateway to talk about AI again. And are we in an AI bubble? That's just a common thing people are talking about in their outlooks for this year. This is probably the most common question you hear. Are we in an AI bubble? Remind people of the dot-com bubble. However, we may still be in the early innings rather than at the peak if you look closely at AI companies' fundamentals, because it will show that AI leaders are making real money and have strong earnings. These are highly profitable companies with massive cash flow, not speculative startup with no earnings like in the dot-com bubble, which caused the markets to drop significantly. So AI also isn't just about software chips. It includes data centers, electricity, power generation, and automation. It's already being used by financial service companies and in the healthcare industry to boost productivity and save on costs. So yes, AI is a powerful long-term trend, but even powerful trends don't go up in a straight line. Pullbacks are normal, and that's where risk management matters. Next section is section 4, why balance matters more than ever. This is where balance becomes critical. While AI may continue to lead, investors don't have to take all their risks there. Dividend-paying stocks help stabilize portfolios when markets get shaky. So this is something that investors could look into this year. And today, dividend stocks include technology companies as well, not just utilities and consumer staples. This is where growth and value comes into play, where if you have a choice between a growth company that doesn't pay a dividend, but has a lot strong earnings and strong cash flow, versus a value company, where value companies are typically companies that have strong dividends, strong balance sheets, aren't highly leveraged, and have good solid earnings where they'll be able to continue to do well into the future. The goal in 2026 isn't to guess which asset class will win, it's to own a mix that can survive whatever the markets throw at us. I don't see a market that either all great or all dangerous. I see a market that offers opportunity, but only for investors who stay balanced, diversified, and disciplined. AI will likely keep changing the world. Interest rates may begin to come down. Earnings are improving, but risks haven't disappeared. The smartest move is not trying to be perfect. It's building a portfolio that can hold up no matter what comes next, especially in the face of uncertainty. But we did talk about a number of things today. Look at growth versus value. Look outside just the United States, whether you're looking at internationally, emerging markets. That's something too that can help your portfolio. What is the fixed income part of your portfolio going to look like, or the conservative part of your portfolio? The type of bonds you own, whether they're short-term bonds, long-term bonds, corporate bonds. This may be something too that you need to look at more, because if you're somebody that's just been in a money market mutual fund or just in a high yield savings account, this year you're not getting the type of fixed rate that you were getting, let's just say back in 2023 and 2022. So that's where you need to be a little bit more creative if you're trying to get a higher rate on the fixed income part of portfolio if you're staying away from the stock market. And then finally, this is the Retirement Lifestyle Show with the first episode of 2026. Please go check out our website, retirementlifestyleshow.com. We have a lot of fantastic episodes on our website that you can check out just to see whatever you're interested in this year. My name is Adrian Nicholson, and thank you for listening to the Retirement Lifestyle Show.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.